everyone, welcome to the next installment of Charts and Perspective, where we use charts to dive into the world of economics and financial markets. I'm Jennifer Nash, an economic and market research analyst for TMX Verify. Today, we're going to examine the federal funds rate and review the Fed's latest meeting. Before we begin, let's discuss what the federal funds rate, or FFR, actually is. It's the interest rate that banks charge each other to borrow money overnight. It's set by the Federal Open Market Committee, or FOMC, a committee within the Federal Reserve, which meets 8 times a year. It's one of the Fed's primary tools to implement monetary policy and is a key driver of economic activity. While it directly affects short-term borrowing between banks, the effects of the FFR can be felt across a variety of entities. For consumers, changes in the FFR influence mortgage rates, credit card interest, auto loans, and saving yields. For businesses, it affects borrowing costs and investment decisions. Additionally, financial markets also react to rate changes, leading to shifts in bond yields and equity performance. So now that we've covered the basics, let's dive into the charts. The FOMC concluded its fourth meeting of 2025 by keeping the Fed funds rate in the range of 4.25 to 4.50%. Marking the fourth straight meeting, the Fed has left rates unchanged. While this move was widely anticipated, with nearly 100% likelihood on the CME FedWatch tool prior to the meeting, there were still many important takeaways from the meeting. Diving into the press release, we can get a glimpse into what the committee members are thinking. They highlighted that labor market conditions remain solid, but that inflation remains somewhat elevated. And even though they feel uncertainty about the economic outlook has diminished, it's still elevated. So, as expected, the Fed made it clear they'll keep a close eye on the incoming economic data, staying true to their dual mandate of maximum employment and price stability. This chart here attempts to visualize the Fed's dual mandate by overlaying the Fed funds rate with the unemployment rate and the two main measures of inflation, the Consumer Price Index and the PCE Price Index. Notice the shift that took place in 2022. In response to soaring inflation, the highest in 4 decades, the Fed aggressively raised rates from March 2022 to August 2023, reaching a peak of 5.25 to 5.50%, the highest level since early 2001. And during the same time, we saw inflation cool and the unemployment rate hold steady just below 4%. The central bank then held rates steady for over a year, finally shifting course in September 2024. They implemented 3 consecutive rate cuts to bring the FFR to its current range of 4.25 to 4.5%. During the same time, inflation has continued to cool, albeit at a slower pace, while the unemployment rate has held steady, shifting only slightly higher, hovering just above 4%. Now, though inflation has cooled from its 2022 peak, the Fed still views inflation as somewhat elevated and is strongly committed to returning it to its 2% objective. So what's next for the Fed funds rate? The CME FedWatch tool estimates the probability of future interest rate moves. It's updated in real time in response to economic data releases, Fed statements, and market movements. This chart here shows the tool shortly after the Fed's latest meeting. At the time, markets were expecting 2 25 basis point cuts in 2025, coming at the September and December meetings, with 2 additional cuts in 2026. However, things have happened since then and expectations have shifted. At the time of this video, the market still expects 2 25 basis points in 2025, but now they're projected at the September and October meetings. Additionally, now 3 25 basis points are expected in 2026, rather than just 2. And again, since this tool is updated in real time, expectations will continue to shift. Now, earlier in the video, I talked about key takeaways from the Fed's meeting. But what we didn't discuss, and is perhaps one of the biggest takeaways, was the Fed's dot plot. Once a quarter, the Fed releases their dot plot to reveal each FOMC member's individual projection for the target level of the Fed funds rate at the end of the current year, at the end of the next 2 years, and in the longer run. In the latest dot plot, the Fed is projecting 2 25 basis point cuts by the end of the year, and 1 25 basis point cut in 2026, With that said, if we examine this chart just a little bit closer, you'll see that for 2025, 7 members are projecting no rate cuts, and 2 members are projecting just 1. But just like the CME FedWatch tool, these projections are not set in stone and will likely shift by the time the next dot plot is released. But again, it gives us insight into what the committee members are thinking. The Fed's next meeting is scheduled for July 29th and July 30th, and the next dot plot will be released on September 17th. That's all for our discussion. Thank you for tuning in. For more economic and market insights, you can find my content regularly on the Advisor Perspectives website under the AP Chart section.